Welcome back to Beyond the Benchmark, where we cut through the noise and talk about what's really changing the investment landscape. Today, we're tackling something that's been decades in the making, and it's about to shake up the mutual fund world again. The SEC just moved a big step closer to approving what's called ETF share classes for mutual funds. Now, that may sound like some boring structural back office jargon, but make no mistake, this could fundamentally change how your investments are built, traded, and taxed. The backstory, Vanguard's quiet revolution. This whole thing started with Vanguard decades ago. They pulled off a little structural magic, turning their traditional index mutual funds into something that also had an ETF share class. Same pool of assets, two wrappers, mutual fund on one side, ETF on the other. And it worked beautifully. Tax efficiency, scalability, and a clean way to serve both retail and institutional investors under one umbrella. The only problem? Vanguard patented that idea. So for years, everyone else was left watching from the sidelines. That patent expired in 2023, and now the gates are open, and firms like Dimensional Fund Advisors are sprinting through. They were the first to file with the SEC. Roughly 80 other firms are lined up behind them. So, what's actually happening? Historically, mutual funds and ETFs were cousins, related but not identical. Mutual funds had multiple share classes, A, C, I, each tied to different fees or distribution channels, but all sharing the same portfolio. Now, the SEC is effectively saying, sure, let's make ETFs just another share class. So instead of creating a brand new ETF, fund managers can bolt one onto their existing mutual fund, instantly giving investors ETF-style trading, liquidity, and most importantly, tax efficiency. That last point, it's the kicker. Let's talk about the tax angle. Mutual funds are forced by the IRS to distribute realized capital gains each year, even if you didn't sell. That means every December, investors in taxable accounts can get hit with a surprise bill for gains they didn't actually cash out. ETFs, different animal. Through a quirky but brilliant creation and redemption mechanism, ETFs can hand off securities in kind, essentially offloading embedded gains to market makers without triggering taxes for shareholders. That's why ETFs have become the tax-efficient kings of the hill. With ETF share classes, fund companies can now push capital gains away from mutual fund investors, or at least shift where those gains get realized. For taxable investors, that's a huge win. For the U.S. Treasury, not so much. Here's where it gets controversial. If this structure goes mainstream, and it will, the IRS and Treasury are going to start paying attention. Because, let's be honest, we're talking about a tax loophole at scale. Billions of dollars in unrealized gains quietly rolling year after year without generating tax revenue. The ETF world has gotten away with it for years because the system benefits everyone. Investors love it, fund companies love it, and the government has bigger fires to put out. But as ETF share classes explode across hundreds of new products, this could reignite the debate. Should ETFs really be allowed to bypass capital gains distributions entirely? We're entering the ETF as a tax shelter era. And while that's a bit exaggerated, it's not entirely wrong. Who wins and who loses? If you're an investor, this could mean fewer surprises come tax season and more flexibility in how you own diversified portfolios. If you're an advisor, it opens the door to mass ETF conversions, legacy mutual fund clients seamlessly moving to the ETF structure without triggering taxes. If you're a mutual fund company clinging to the old model, you're on notice. Because the ETF tidal wave isn't slowing down. And now the barriers to entry just collapsed. The big picture. Let's put this in perspective. There are already over 4,500 ETFs trading in the US. That's almost as many as there are individual stocks. Now imagine another few hundred getting tacked on as ETF share classes. Same strategies, same portfolios, just with a more efficient, transparent, and, frankly, investor-friendly wrapper. The structure that Vanguard pioneered as a quiet efficiency play could end up redefining fund distribution for the next decade. And maybe the most ironic part? This whole thing started as a Vanguard patent, the company that prides itself on not marketing, not chasing trends, and just staying the course. Yet, here we are, 2 decades later, everyone chasing Vanguard's innovation. So yeah, ETF share classes might sound like an inside baseball regulatory move, but this one's worth paying attention to. Because what's really happening isn't just a structural tweak. It's a revolution in how money moves, how it's taxed, and how investors access the markets. And like every revolution, somebody's about to lose their seat at the table. I'm Kasper, and this has been Beyond the Benchmark. Thanks for listening, and until next time, stay focused, stay informed, and don't let the noise shake your strategy.